Well, it's 3:03. We can get started. Thank you, everybody, for joining. I appreciate you. I'm very excited to talk to Dave Stangis, the Chief Sustainability Officer of Apollo, maybe the world's largest, or pretty close to it, private equity fund. Just so folks know, there's a Q&A. You feel free to ask questions. There's a chat, so you can drop things in the entire conversation, and we will get to it. Um, and welcome everybody. Dave, thank you so much for joining. So just I'm going to introduce you very quickly, but CSO of Apollo. Before that, you were the CSO of Campbell's Soup Company. And then before that, you were the Director of Responsibility at Intel. So you've been doing this work or work very related and under all the many names that it's had for your entire career or close to it. And I want to start with names. I'd sent you a list of questions before we talked, and you said, "Yep, all the questions look good, no problem." And then you wrote, "Quote: I'll need to tackle the ESG acronym earlier in our conversation."
Right. So you
So
asked me the
let's
first.
tackle it.
You asked me the first question you had down there, and I'll weave it in.
Okay. The first question I had down there was you worked at the intersection of business strategy and ESG for decades. How do you make ESG feel like a value driver instead of a compliance burden?
Right. So I think some of you I know on the call, but there's many that I don't. The business strategy piece is literally what I have done from day one. That has been consistent. I created this role at Intel because the business needed it, and the world kind of demanded it of a company like Intel. Stakeholders, were building campaigns and asking questions and trying to be with the company was trying to be transparent, managing shareholder resolutions, the same things companies do today, except this was 25 years ago or so. And ESG didn't exist as an acronym. Even really chief sustainability officers didn't really exist, but this concept of having somebody to manage corporate responsibility and reputation did. And there were a couple of us. There's Bob Langert at McDonald's, there's a guy over at Shell, but there were literally like three. But it was a business strategy, and at the time it was called corporate responsibility. It had the same buckets that you would call an ESG strategy today: reporting, stakeholder engagement, OpEx improvements, cost savings, go-to-market strategies, reputation management. So that's how I make. If what you're doing in your company is called ESG today, I'm making a positive assumption that this is a strategic initiative and not just reporting or not just community relations, but it's being built to help the company achieve its objectives in a way that also drives customer, consumer, supply chain, value chain, long-term shareholder, short-term shareholder impact as well. It's really focusing on the strategic and literally like prohibiting people from using that acronym. I used to walk around the walls at Campbell and say, like, don't use the S word, because it was shorthand and people had different definitions of what sustainability meant. Some think it's the big umbrella, some think it's just environmental sustainability. And that's really, to get to your point, Adriel, is like, how do I break? And that's why Apollo recruited me and why I came. And I came to help them build a business strategy to take advantage of what the world and what the marketplace that they were dealing with was calling at the time ESG or sustainability or sustainable investment or climate investing, and the demands they were getting from their investors and LPs. I just want to add like one or two lines of context for level setting for people that don't know Apollo very well. You described us as one of the world's largest private equity firms or funds, I think you said. We're one of the world's largest private capital firms, but we do private equity. We're about $785 billion under management. There are some bigger, not many, in terms if you use assets under management as an indicator. About 13%, give or take a few percent of that is private equity, what you would expect, right? Investing in, owning majority stakes in our Apollo funds, owning majority stakes in portfolio companies. Many companies you would know, like recognize their names, and these are things that are public. We make announcements, we make these kind of investments. The vast majority of that investment is in credit, origination, lending, investment grade lending to big companies with names like the people here that work at those companies, lending for project finance, capital expenditures, mergers and acquisitions, those kind of things. And my job at the top of the house is to build the strategies for all of that. I have a team that's focused on private equity, helping portfolio companies get better, a team that's focused on credit, think of reporting, transparency, engagement, and stewardship, all doing risk assessment and value creation.
Amazing. So I want to talk a little bit more about words and especially about how they change year over year. So I want to share three quick things. The first is that 3 weeks ago, Apollo Global Management was named the Sustainable Investor of the Year by Global Capital. So that's exciting. Next thing, I saw a Forbes article that came out last year, headline, How BlackRock Abandoned Social and Environmental Engagement. Third thing, I read the press release for when Apollo announced that you are joining in 2021, and they used the word ESG seven times in the press release. And the quote from Apollo CEO Mark Rowan, one of many, welcoming you, is sustainability is simply better business and a critical component of our long-term growth strategy. And so those three pieces of information, I think if we take the story of like, the Larry Fink letter came out in 2019 or whatever, when everyone was very excited, 2021, Apollo brings you in. The IRA is being worked on. This was like ESG reports were 700 pages long. This was very exciting times. And then over the last 4 years, two of the largest private capital companies, if you guys are in the same world, took slightly different directions where Apollo seems to continue to lean in and win an award of Sustainable Investor of the Year. And folks like BlackRock seem to lean out. You don't need to comment on BlackRock, but I think the divergent paths are very clear. And I want to know inside of Apollo, what are the conversations? Why lean in when a lot of others are leaning out?
Okay. So some of the specifics around the business help, right? I won't go too deep in the weeds. BlackRock is a public asset manager, meaning public funds, they manage other people's money, that kind of thing. Apollo is a private capital manager. We approach this in different ways. We do not launch retail focused products that are labeled ESG, green, sustainable, that kind of. We may have strategies, we have impact strategies, and we have a clean and transition strategy. We have deployment targets of 50 billion and 100 billion in clean and transition investments, 2027 and 2030. But there's a difference between like labeling things, which whoever you were, this is a green can, this is this is an ESG company. Like that means something different to Sustainalytics, to MSCI, to the person on the street, to a bank. That's not helpful, and that's what happened. And once that kind of car went off the rails, the companies, more than one, got in trouble for labeling things and then not being actually held accountable to doing what they were supposed to do. This happened not only in the US, but it happened in Europe with companies as well that we could name and you could search for them. It happens in the marketplace, anti-greenwashing legislation in Europe and in the US. So some people basically companies went too far in terms of taking advantage of the buzz, and some of them had to retrench or kind of get back to where they were. And some maybe, if you over swung one way, maybe you overcorrected in trying to put that genie back in the bottle. We've been approaching this from the beginning. When I came to Apollo, I gave them a 100-day plan. They knew they needed something. They were sensing from LPs that their investors, their clients, their limited partners, the people that were giving them assets to manage, expected better capabilities, a better competitive advantage around sustainability, insights into my investments. What are my investments doing? What am I actually investing in? Are they making the world a better place? What direction are they going? Where does Apollo stand? How does it compete? And they knew they needed that, but they didn't know what that was, right? So I give them a little bit of a 100-day plan about, I'm going to build this thing. And without being able to describe it, I can tell you what success looks like, right? You're going to have the metrics to know what to measure. You're going to have a governance system so you know how to make decisions. You're going to have a communication plan to go about it. You're going to be able to manage risk better in a more robust way. You're going to have a more structured approach to trying to find value. And so the light bulbs start to go on. And all of those things I just mentioned, right? Metrics and governance and risk and strategy. You don't need ESG or sustainability or corporate responsibility to describe them. It's a competitive advantage. And that starts to build a flywheel. we talked about net zero, right? We had companies asking us to sign to a net zero target. I have good friends in the net zero asset managers, alliance and everywhere, and I've been in the space for a while. So, but I talked to all of them. I brought them in. I asked them to explain, in this company, in this sector, in my business, how those things work. And I really couldn't get like a solid, oh, here's the pathway. Here's how you do this in a private capital firm like Apollo. None of that. So I told my leadership team, I said, look, like we're going to do an Apollo version of this that we can stick to. We're not going to overpromise. We'll over deliver, but we're going to focus on delivering returns and managing risk and helping Apollo be better in a way that we can be more transparent. And that's why we haven't had to go this way and that way. And the capabilities, just a couple little snapshots. If anybody's interested to like dig a little deeper, there's a decarbonization white paper that's out on our website in our insights section that you'll ask me a little bit about it, and I'll point to it in a minute. And there's a credit white paper, actually the third iteration that my credit team has put together. They're both really good pieces of work that give a sense of like what we built underneath the surface that our investors read, right? They get it, but not the general public. And that's the meat of what we're building versus like a claim. The awards come, right, which is great. I'm always happy to have my team be recognized, but it's more about the capabilities.
I think one of the um, in the peak of ESG hype, 21 and 22, and many people were setting net zero targets, and you see a lot of them being walked back now, and partially politically, but also partially people have said stuff that they don't know how to hit. I think those are a really big
Right.
part of it. Was it's not necessarily malicious that they're walking it back or they're evil. It's just like, oh wow, we actually realize we're pretty close. We're not able to hit it. And I think
Right.
one of the challenges is it's very difficult to read the label from inside the bottle. And in
Yes.
2022, we were all in this bottle and it was shaking like crazy. It was very frothy. It was very exciting. My friend at this company is doing this. I got to keep up. My peers are saying this. Every investor on earth wants this. And the law says this, and everyone's getting there. And now that we're a few years removed from that and the politics have changed around it and companies are taking a step back, all of a sudden, I think many of us are able to have a clearer view of what is useful, what is just kind of we're strutting a little bit. What is actually making the sort of impact we like me and my company wants to make, which may be different than you and your company, and we don't all fit in the same bottle. I'm curious for you. There's a lot of people who have been very in our world who have been very anxious the last 6 months. I
Yeah.
think there's plenty of reason there, but I think there's also a lot of good things that might come from this realignment and this step back and the ability to like get a clear view of what's really important. When you talk, kind of two-part question, when you guys talk internally for Apollo as the finance company, and then when you talk specifically, maybe on the private equity side, like with operators,
Mhm.
what are they, what do you hope people do much better now with this clearer lens and less froth than they maybe were doing a couple years ago? What's the
Yeah.
positive side of this?
I mean, there was actually a story in Bloomberg about kind of this point. It was a different kind of angle, but will this kind of crucible environment, actually be a good thing for some
Yeah,
companies and
just
programs,
read it
right?
this morning. Yeah.
Right.
Yeah.
And the short answer is yes, clearly, because you can see companies refocus, getting a little bit more, I would say, kind of honest with themselves, and then by default have to be honest with the public. I won't speak for other companies, but I thought like the PepsiCo story that was in the Wall Street Journal 2 weeks ago, where my friend had to like say like, hey, the world was a different place, and we did it. There was definitely comfort in numbers, right? If every company's doing this, how much risk really is there if all of our peers are doing it? It's almost like we're outside of the house, and they're all in the house and they're all getting celebrated. Like it's more risky to be out. So I'm going to go in, even though it's a leap of faith or I'm not exactly sure. So you can kind of understand how people got there. Um, in the firm, when I'm talking to the leadership team, I have a board committee that I meet with quarterly where we have a lot of these conversations about how do I interpret what I'm hearing. It's still a lot of education. It's a reminding. You're reminding them and other parts of the firm that what we built is built in business strategy. It wasn't a buzzword. It wasn't a claim that didn't have backup. And I'm doing more of that. I have to admit, we're a firm of, 4,000 or 5,000 people on the asset management side and the Athene side. They read the newspapers, they all watch different channels, they all listen to different things. And, I've had questions from people that I worked with for 4 years, is this all going away? Is this changing? So there's a lot of education that goes on. And that's a good thing. I think it's helpful to have people really, because it helps them learn, like, some weren't paying attention before, right? As much as I wanted them to, perhaps. And now they're like, well, now I don't have to pay attention. I said, yeah, your clients are asking for, the reason we're doing this is because your clients are asking for this. So here's an example of a big mandate we just won, or a big investment we just won because of this capability. On the Portco side, it's different, right? So whenever we talk about our portfolio companies, there's hundreds of them, right? And we also, at the same time, in a couple of weeks, will publish a summary of portfolio company performance and all the data sets. And you're probably one of the few people that have kind of seen these two things and know what all these reports are. But they're think of them on a maturity curve from, 1 to 9 on a 0 to 10 scale, right? So there are companies that are leaders in this space. They do their own report. Maybe they were publicly traded and we brought them private, or they're in Europe and they've been under a little bit more pressure from their customers, or they have customers like Walmart and Amazon that have been asking for them. So, and you have some that are like, when we come to them with our 100+ survey and need to understand their scope 1, scope 2, scope 3, their training around governance and cyber and AI, and they're a little overwhelmed. Like, we're training them, we're bringing them up to speed. The companies in our flagship strategy, though, have a 15% carbon reduction target normalized for that portfolio. So we need the data, we need to be working on strategies, we need to get them along. There's not a lot of chest thumping and claims being made among our portfolio companies. These are hardworking, Apollo. There's a few in there that are well-known brands that you would know, or that you might see in the news. And they have reputations to manage. A lot of them, their biggest reputation to manage is with their customers and their supply chain. So it's the kind of core sustainability risk we always work on. And we have to have a similar conversation with them. We're doing this to reminding them that we're putting them through all of these hoops because we're trying to manage risk, identifying the real commercial and OpEx opportunities, the financial opportunities, and to make them more valuable on exit. It's good for them. It's good for us. It's good for our investors. And there's more education, or more kind of reminding people why we're doing this. But I think that's all a good thing in the long run.
You guys write that in slightly different words. You guys, like an hour ago, or at least I just saw it an hour ago, released an impact report, and we can talk about impact being different than ESG and all that. But the first paragraph of this report, I'm going to read just part of it here. But I think it was the CEO, maybe whatever, whoever wrote it, said, to say there's been an enormous amount of change in the 5 years since we launched the Apollo Impact mission would be an understatement. We write this amidst a fundamental realignment of the financial system in a wave of political and regulatory shifts that have and will continue to reshape the global investment landscape. This dynamic situation has required us to be nimble and to be both principled and pragmatic to stay true to our mission. And this line I like. We cannot control the macro any more than we can control the weather, but we can be and are prepared for any storm. Good little climate reference there, analogy. When you think about that and you think about risk, which everyone's always talking about sustainability as risk, and it feels like there's, at least in my simple mind, two parts to that. There's strategic risk. There's there's risk that our customers don't buy us or don't spend as much money on us, or deal cycles take longer, or regulations impact us, or it's harder to go public, or it's harder to grow in Europe. These are all strategic risks, and the solutions to that could be buy more clean energy, decarbonize, be transparent about your work. And then there's operational risk, which is wildfires suck and they can burn down our factories, and more frequent or more intense hurricanes are problematic, and they hurt our retail sites, which means we have to rebuild and we can't sell. As you guys think about risk, and the politics around all this changes, like you wrote that it, like obviously it has over the last 5 years. So how do you think differently about those two categories of risk, if that's even the right way to think
Mhm.
about it? And then how does one team have both of those conversations at the same time?
Yeah, so it's a really good question because it illustrates a little bit about how we do our work, right? So that first bucket of risks that you described as strategic risks, all around customer demand, could be incentives, could be, all kinds of tax structures, growth of this sector, like if we thought it was going to grow more, then
Hmm.
these
Hmm.
are all kind of pressure tests that are done during due diligence, right? Or they might be done as part of a lighter due diligence on the credit side. But let's pick an equity company, right?
Hmm.
So we're running scenarios, or not myself, but the deal teams with our team's help. We are helping them take a look at the the risks that actually do fall into categories that you could bucket E, S, and G, right? We brought
Hmm.
in the SASB sector standards several years ago and take a look at sector-based risks, momentum, score all these things, and help the deal teams run scenarios of optimistic, pessimistic. Here's management's projection. Here's our projection. Here's our third-party experts projection. Where do we feel like these risks flawed? And they're the strategic risks are kind of summed up, right, in the due diligence, and then they're managed under the equity ownership of the company with the existing management team or people on the board, but they are managed and you could think of them in very big buckets like commercial risks, like can we is our growth projection still on board, and that would factor in with the political environment, geopolitical risks, cyber, just all the other things, including climate, regulatory. You could put transition risk there too, because we look at transition, regulatory, technology, both good and bad risks and ramps in that strategic part, in that due diligence part, and we work on that, and then that works out through the holding period. The what I will call physical risk, which is what you described the second time, or the second part of that question, we've been actually doing a lot more of that. Major physical risks that are kind of obviously material to the investment are taken in that strategic bucket, right? We deal with
Hmm.
those in that first bucket, right? They got three plants on the edges of sea level rise, and they had four floods in that area, but on the kind of the new version of physical risk, we're building internal capabilities. I've got three people on my team that sit in our IT organization, great capabilities, great abilities to like connect data systems and code and build additional capabilities based on our data. We've been doing, as you know, because of your work, doing a little bit of work on scenario analysis, both like top down, what's it look like in equity and credit, but then what's it look like across a single fund. And now we're doing specific pilots with specific companies because physical risk is clearly certain companies have more at stake, whether it's facility, processing shipments, transportation. And I would say the physical risk, and I would not expect this just to be happening at Apollo, but the physical risk capability is really ramping up. But it's not something that, like, when I got here, we weren't doing all of, like, we've done much more work on physical risk and bringing that to the portfolio companies. Some of them aren't all ready for it yet, right? Because it's kind of like advanced. Now we're kind of, we've gone from the 101 to the 201, kind of up to the 401 classes. Um, but there's some companies that really see it. You can see it playing out. They're using it to make decisions. And every company's got a business continuity plan, right? So even thinking about where Apollo has investments and resources, and then thinking about places where we can do retrospective analysis, like the wildfires in California. Obviously that was a disaster that happened, but then making sure we're learning from that. Go back, what portfolio companies own buildings and facilities in that area? Were they impacted? Did they have insurance coverage? What happened to the insurance coverage cost? For us, everything comes down to cost, right? I mean, really pricing the risk and trying to price the value creation. Um,
Hmm.
Different tools, less tools than a big branded company, but different tools.
Why do you think that is? If you use startups just as one metric of like finger on the pulse of what's happening in the economy, 93% of investment into startups goes into mitigation, so like decarbonization, as opposed to adaptation, so physical risk. If you just look more anecdotally, something like maybe 10, 12 years ago in Europe, 7, 8 years ago in the US, all these carbon accounting companies started popping up, Watershed and Persephone and Europe Plan A, Greenly, like big companies raised a ton of money. Carbon accounting became this big thing, and climate risk, which is Beehive's world, is a relatively newer world, which in some ways is a little bit surprising because natural disasters have existed forever, whereas the GHG protocol is about 20 years old. But why do you think that is? Even you guys, Apollo, like one of the more sophisticated financial firms out there, saying physical risk is very new to you, but your impact report is even older than your physical risk program. Why does it surprise you at all that physical risk work
No,
is newer? No, why
it
is that?
it it, it did surprise me until I came here, right? Like I didn't come out of the private equity world or the private capital world. I mean, I have an old finance MBA that I probably forgot, 99% of. I've learned a ton here. This has been like, baptism by fire PhD and especially macroeconomics. But it literally comes down to the levers we can move within the time we have, right? We hold companies for 5 to 7 years, 3 to 5 years, 3 to 10 years. You pick the window, right? Um, we can react to disasters. We have to. Everybody does, right? But what can we can manage? Where can we find? There's in the report that comes out in a couple weeks. Um, I won't refer you to the page in case it will change, but we list an example of how we're continuing to kind of the apps team, the private equity, basically, sustainable and responsible operations team has been working on this for a while. And I keep asking them to like distill this out so we can tell this story. And based on those targets we set, they go through and look at every single opportunity they have, how much it costs, what's the return on investment, what's the window. And we, have control charts, and things that are in the control
Mhm.
charts get implemented. And there's tens of millions of dollars being saved and tens of millions of dollars being identified as opportunity and value creation within the holding period. And that's the biggest reason when you start to look at and it's not just Apollo, it's every company on the planet, going to your question, is where can I invest? Where can I deploy capital? Where can I invest my capital or CapEx or OpEx to deliver return that I know has some confidence interval and a window? And I'm
Mhm.
a CFO, I'm a treasurer, I got people asking me for money. Clearly, things are happening in the physical risk space, right? What we know, like everything that's happening today, climate scientists have been telling us for decades, like this is going to happen. And we're like, oh my God, that would be terrible if it happened. And now it's happening. Um, and the money flows to the disaster, but it's also a different pool of money, unfortunately. Like I've been at a lot of panels about blended finance. And the reason blended finance adaptation and resilience investment hasn't taken off as much as I would love to see it, because I know it's needed and there are returns there, is because the world hasn't figured out how to match the return requirements of the different players to the projects.
So just like a time scale issue, like can you
No,
get
I mean
enough
it.
money back?
Well, for everybody else, everybody on the field has a return need, not just an expectation. Apollo doesn't do discretionary investing. That impact fund is a private equity impact fund with 20+% expectation returns from the people that gave us the money to manage. Not $1 in that impact fund did somebody say, I only need 80% back, right? Because I want you to do positive.
Yeah, it's not charity. Yeah, it's not,
Right.
none of
So
it's.
and so the discretionary capital, the capital that doesn't need a return, or the capital that is willing to take less of a return, matching those pools of capital together is the biggest challenge on big blended finance. And I think, but to your first part of your question, I don't mean to like draw this out, but it really gets down to the person in the firm, the CFO usually, or the finance department allocating resources and trying to say, what can I deliver return from? And more
Yeah.
is going into physical risk and adaptation and resiliency, because those pain points are getting more visible, and firms like us and others are building better capability to help companies make more informed decisions.
Yeah. Um, I have plenty more questions, but just a reminder for folks, there's a chat open and a Q&A open, so feel free to pop in there with anything. Um, Expand that trend line a little further. So if we go in like 5-year increments and we say 2015 to 2020 was the the beginning of some like formalized processes, big brand commitments, maybe a lot of like sustainability as a marketing advantage or a brand strategy advantage. And that was that 5 year bucket. And then with maybe a Larry Fink letter or like Apollo bringing in leadership like you, 2020 to 2025 was the uh, let's bring regulations to this. Let's really focus on net zero targets. SBTI got really big, and that was the like global kumbaya. Maybe that's too soft of a word, but like that was a decarbonization, bringing in regulatory target setting around mitigation. Expand the trend line. The next 5 years, what's the focus of corporations around these topics?
Yeah, yeah, taking a global perspective, just a U.S. perspective. I do believe, there's a little bit of this distraction right now, I would say. Um, but the macro picture that you touched on several times, weather, literally, climate change and the impacts and the cost and who is impacted and the kinds of companies and the types of people on the socioeconomic scale are going to continue to get impacted. It will affect home prices. It's already affecting home prices. It's affecting the insurance market. It's affecting business. It's actually causing what I would describe as forced migration or forced mitigation. Companies have to move their workforces in certain parts of the world. Think about people that are working outside, agriculture. These things are happening already. They happen at a pace and they happen at a scale that like everybody doesn't feel, but they're happening and more people will feel these things. There's distraction in the US at the moment, but the climate thing will not go away. Water will continue to rise in terms of priority. Um, and access to water, access to healthy, clean, cost-effective water. Um, the energy build out that will continue, the gap between what we need to power the AI infrastructure and what we can build and put on the grid is like immense, and it's not closing. Like, doesn't matter what anybody says, you can build as many power plants. Yeah, like you could build every power plant on the paper in paper a day, and you still wouldn't catch up. So there's going to be work around making energy more efficient, more green, more renewable, whatever word you want to use, as we go. Whether that means small nuclear, modular nuclear plants or whatever. There's going to be a lot of work in that. It may not always happen right in the U.S. in the near term, but that's going to continue. I do think that this long-term trend of I have an ESG program, I have a sustainability program, I have a corporate citizenship program. I do something for the environment, I do something for my employees, I do something for my customers. Like that's all good, but that was many companies have moved beyond that now. Like what can I do as my company? What's the strategic thing for me? How do I actually continue to make money? And the greenwashing, I think enough companies in every single sector have gotten the lesson learned. There still happens. But literally you're getting smacked all the time, whether it's Europe and the US, companies doing like not smart things or saying one thing and they're getting caught doing like they really didn't do what they said they were going to do. I think the greenwashing space will really clean up. And I think people hopefully have learned their lesson about labeling things broadly. The precision around language, very positive, I think. Like I want to weigh in when I see somebody try to come up with another acronym. Like we'll move from this acronym to another acronym. We'll come up with like that. Well, you don't like that buzzword? We'll use another one. I restrain myself sometimes online, but I don't think that's a good idea. I think actually talking about what we're doing, there's a huge opportunity for sustainability professionals broadly. They may be procurement, marketing, human capital, materials, um, but the concept of building a more resilient business is what we've all done for all these years. So our titles might change a little bit, but there's actually more opportunity.
Yeah. For what it's worth, I once or twice a week or so, I talk to somebody about like their career and they want to break into the climate and sustainability. Everyone says they want to work for a startup, and I tell everybody, no, you do not.
Right.
But once we get past
Some
that
people do,
conversation,
and they just have to know what they want.
they think they do. No, nobody does. You got to be sick to do what we
I get
do.
a lot of people that say they want to work in private equity, and I say like, so what do you mean? Like,
Yeah.
what do you think that means? Right? Yeah.
They want to make money and wear vests. Um, Easier ways to do that. But whatever, the two buckets I always say, like I think these are amazing places to work over the next 5 years are clean energy, like you said. I think like clean renewable energy that's cheaper and that's more reliable, and we need more energy. Like, put the all right, politics, tax credits, yada yada. Maybe it'll be bad for 2 years, but like it's not going anywhere. So that's one bucket. And the other one, I gotta remember this guy's names to give him credit. But this big private equity investor talked about the unavoidable opportunity in resilience and adaptation. And what
Right.
he basically said was there is no curbing emissions through 2040. Like everything that like it's already set. We can make a difference beyond that, but like we know exactly kind of what's happening through 2040, the range of outcomes for emissions, and then therefore natural disasters that come of that, and the increase in frequency and severity. That's set. Like there's no changing that.
Right.
So what's the opportunity over the next 15 years if we know like it's only going to get worse and it's going to get this much worse, and it's not like in 2041 all of a sudden we live in a happy sunny place all of a sudden. Like there's amazing uh opportunities and resilience. So those are the two places I point people to, kind of like you said as well, around energy.
Yeah, I'm a big I really do wish there were more ways for companies to get excited and to deploy their kind of both intellectual capital and financial capital in resilience and adaptation. Sometimes adaptation is a bad word, and I don't mean it to be. I'm trying to be realistic in what you just described. Even if you shut everything off tomorrow, the weather patterns are not going to like revert back to 1800s. We're stuck with some of these rainstorms that sit over a city for 6 days and drop 12 inches. Like that's going to happen, and they're getting smarter and smarter about where that's going to happen,
Mhm.
and preparing both the social impact as well as the kind of environmental and infrastructure impact. The amount of infrastructure spending that is going to happen in Europe, for example, over the next 5 years is going to be astounding. And can we do it in a way that we're thinking out 20 and 40 years from a resilience perspective? Can we build things that will are more efficient today and will be more efficient or designed for efficiency in the future?
Yeah.
Somebody asked me a question yesterday. Am I seeing companies kind of stepping up their work on circularity? And I've known this guy for a long, long time. And I said, look, to be honest with you, I can't say that I have, but they're not using circularity, but reshoring and resiliency. And you just follow the cost of materials in the current environment, whether they stick or they change or whatever.
Hmm.
There's definitely work going on about how can
Hmm.
I reuse these things in the geography that they are.
Yeah.
They're not calling it circularity, but there's definitely opportunity in there as well.
Yeah. Um, let's talk about politics, Dave. Sounds fun. Somebody asked a question in the Q&A saying, has it been easy for Apollo to stay ahead of legislative requirements in this space, or has legislative volatility or evolution required a lot of time to deal with? Another way of saying that is, how do what does your team structure look like
Yeah.
to look at policy and politics? Because a lot of companies here, actually, I know a lot of the folks on this call, and we talk a lot about how do you track regulations, and it's almost always we read some newsletters, we put it into a spreadsheet, we call our counsel when there's something, and sometimes that's good enough, sometimes we miss stuff. For a team like you, how do you track legislative requirements that matter?
Yeah, no, it's a huge strategic. I have 3 lawyers on my team, 2 in London right now. One will be on his way over here, and one, my lead, is here in the U.S. We have a regulatory update. We have external advisors in the U.S. and in Europe and around the world that help us keep track of these things. The 2 things I've told my leadership team, like the leadership team at Apollo, that surprised me. They often ask, like, is this fun? They ask, and they're like, has this been what you expect? And the reporting factory that I've had to build and the regulatory environment around reporting, we do, as you people on some of you know on the phone or on the Zoom call, we do an enterprise sustainability report. Obviously, you saw our impact report.
Mhm.
As part of the enterprise sustainability report, we do a portfolio company report. About 100 companies are in that. We do about 1,000 other reports a year. Credit reports, regulated reports, more than 20 products regulated under SFDR. Some of those have different sleeves in different geography. The reporting infrastructure, and when Europe decides SFDR looks like this and now it doesn't look like that, and the naming rule around what can be in a fund name is this, and we're going to add a new name to the fund name thing, and the US does this,
Mhm.
or SEC is going to do.
Mhm.
So we're preparing for all of those things, but whenever there's a kind of waffling in public policy, we also have to react to that. You know,
Yeah.
the kind of the carbon offsets, whatever the right rule is in California, that was kind of written last year, but nobody knew if it was in effect. We
Yeah.
basically pressure tested that rule last year. So this is the second year we're like in compliance with that, but we use our reporting factory to test these things out. Our
Yeah.
regulated reporting in the UK just says, hey, go look at what they're doing over here because it's the same. So I've tried to build one reporting process, but we have a like a regulatory reporting review that goes to our board almost every quarter. I bring in my head lawyer with me when I'm meeting with them, and like, here's what's going on. Scenarios, map out every single state, red state, blue state, what's happening. We have an internal call every month for all of the people on my extended team, so they can understand and ask questions about a lot of these state things. Are they policy? Are they words? Are they real? Are they actually going to do anything? You know, yeah, it's a full.
Now, are you doing all this to be ideally proactive, worst case reactive to these things? Are you doing this so that you can lobby for or against things that you agree or disagree with? Are you doing this like what is the point of all? Like you could just wait
Well,
for a law to come out and then go do the work.
I have two design criteria for kind of what I'm building. One is to be kind of delight my customers, LPs, investors, pension funds all over the world, like to be one step ahead of almost all of them. There's always a few that are kind of like, give us more. And the other one is to be one step ahead of the regulatory environment. So it's not to be proactive or reactive. There are times we've weighed in. There are times we've kind of partnered up with our peers or used a trade group to weigh in. But for the most part, it's to be one step ahead. One step ahead of our peers. Like this reporting, I'm doing a panel at Reuters coming up later this month. Reporting is good. It's a thing that drives transparency. It helps the company learn. For Apollo, it is literally a strategic competitive advantage capability. It's not it's nice to do. That's good. But there's to help the firm understand where they are, it's the most downloaded piece of PDF content on Apollo.com all year long. So that's nice and that's great from a reputation perspective. But it is basically competitive differentiation in the market for us to attract origination and to attract investors.
Yeah.
Which I think is different from it was different from it was at Campbell and Intel.
Yeah. A question here from somebody who said Apollo buys offsets and Rex. Do you think all private equity firms should be doing this? And is this something that they will have to do for the foreseeable future? And will it spill over to portcos? I'm also going to add to that. I used to sell a lot of offsets in my day. And I think I'm so glad that the conversation on offsets is evolving. When I started doing that a few years ago, everyone was saying, how do I be carbon neutral for the cheapest price possible? Which is just a simple, like, it was backwards then. And finally, people are agreeing with it now. Like, no, for $3 a ton, you can't wipe away all of your problems in the world. Like, that doesn't make any sense. And so I was pushing, I wrote this book 2 years ago. And in that book, I was talking about instead of trying to be carbon neutral, focus on like carbon contributions and just saying we support these sorts of projects and I call it like a carbon equivalency cost. If it costs you $100,000 to be carbon neutral at $3 a ton, don't buy stuff at $3 a ton. Buy stuff at $300 a ton. Spend the same 100 grand, but don't be carbon neutral. Just say this is the kind of work that we do with offset. So I'm very glad that's evolving. I think there's so many problems and such a bad rap that poorly run offsets gave to all the work that people in sustainability and ESG are doing. And feel clearly strongly about that. I've also seen you post about direct air capture and some of the important work in carbon sequestration. So I added a whole lot to that question. But the question was simple: should all PE firms be buying offsets and RECs? And do you think that'll change in the future? And will it spill over to portfolio companies?
Yeah, the question doesn't actually match. It's not that it like doesn't match reality, but it doesn't match reality in terms of like how it's working. The reason we do it is number one, to as you kind of point out, to demonstrate the kind of transparency we can build, the capabilities, the insights. As a couple of you know, I have a climate expert on my team who this is what he works on, right? We're trying to tell the right story around sequestration. We're trying to make investments in places that match our geographic footprint, kind of expanding from, you know, 1 and 2. And then we're talking about that. We're helping our LPs understand it. We're helping training our portcos that want to do it, like what's real, what's not, what's the best approach, how to find the most credible. We're setting very high kind of credibility thresholds. I don't know if every private capital firm did this, then I'd rather they not. I want to be a leader. Like I don't want, I mean, you know, like, you know, whatever they call it, you know, if they copy me, that's nice flattery. But like, I think some do. I don't go in and like look at their books and are they only buying offsets? Are they doing sequestrations? But I think there's two others in like the major publicly traded private capital firms of the five or so that are there that are, you know, buying Rex or, you know, I don't know, they're trying to zero out their footprint. Like, but the reality is we're doing this for a strategic purpose, right? To go back to the, like everything I do, if somebody stops me in the hall and asks me like, why are we doing this? And I can explain it and talk about it. There are reasons. If somebody came to me and said, look, do we have to spend that money? Is anybody making us spend that money? Like that's a real question, right? Is the capital we're deploying a good investment? And at Apollo, it better be. And this is a conversation I have with my climate guy all the time. Like I'm always pressuring him on like, look, like what's the reason? Like, not only do I have to understand it, everybody has to understand it. Yeah, a lot of people are walking away from these things right now because there was a lot of problems in the marketplace. All it takes is one bad, you know, project to get, you know, fraud or go off the table or somebody poke around at it and about permanence. And that tarnishes the entire sector. Companies like Microsoft have, you know, basically built a reputation and have spent boatloads. Amazon too. You have to give them some credit, right, for kind of carving the way for others and investing in some companies that probably wouldn't be around. But I would say right now, more companies are like pausing or stepping away. And I'm not sure. I think that the cost effectiveness of some of the real technologies will come down and that will grow. I don't know about this, you know, cheapest offset, bundled offsets for $3. That kind of stuff might go away. Unless I'm in
Right, that it does.
Unless I'm in California and I'm on a cap and trade program and I have to do it, you know, and then
Yeah. Yeah. A question about kind of we didn't talk much about you as an operator. Um, I spoke to a company yesterday that's a little over $1 billion in revenue. And I spoke to a lawyer on their team who was sort of tasked to figure out the California climate disclosures. He just joined a month ago. And the general counsel is basically like waiting for this new person to join so that she can be assigned this work. And they have not done anything formally for anything related to climate or I guess you could say ESG. I'm sure they have some like diversity programs or whatever, but like they haven't formalized anything at all about this, which was really, I guess, someone in the world a little bit surprising that $1 billion revenue business that's been around for a while hasn't done this. But hey, if you were starting a program from scratch, you didn't have any of the baggage of a company that's been doing this for 5+ years, where would you begin today? And obviously that depends on the type of company. So maybe like you can call it a CPG company if that's your like most comfortable background. But where would you start today?
I actually, you know, this a bit of a soapbox. I won't make it a soapbox, but I don't think it matters what sector you're in or what company you work for. If you were hired, my recommendation to you would be like start on a listening tour with the top of the house, figure out who owns the power, who's driving what's the company strategy from a commercial perspective, what's the company strategy from a talent perspective, do they have a strategy around reputation, what's the strategy around reputation with customers, what's the reputation, you know, with vendors, do they have a growth strategy, do they have a 5-year plan, what things are hard, what things are easy, what products or services do they have the highest margin on, which ones have the lowest margin, like and really in all of these questions, because you're the sustainability expert, not these people you're talking to, what are they trying to drive, what are they held accountable to today, what goal did they sign up for this year, what does it look like, what's their vision of success 3 to 5 years if like they hit the ball out of the park every year, and then you start to design your here's where we want to be to here's where we are today around the things you can manage from a sustainability perspective. If I've got metrics, if I've got reporting, if I've got citizenship and employee engagement, training, talent development, things that I can work on, procurement, supply chain, ingredients, products, packaging,
Yeah.
communications is a huge, the people that work with me at Apollo know, they kind of know my,
I met you through a communications person at
they know
Apollo. I posted about you and they said, how'd you find us? Yeah.
they know I'm a full-time member of their team, and they're a full-time member of my team. And we meet and talk all the time. And I think it's in internal communications. I think these are, in some companies, hugely underleveraged assets to be managed for
Hmm.
sustainability. But that's what I would literally design, and I didn't do this the first time. Like, this is not how I did it at Intel.
Hmm.
But I learned, and then reflected back on the process, and it's a process I took to Campbell and I brought to Apollo, and I teach. And you can do it in a couple different ways. You can follow people, you can follow products, you can follow dollars, but through the company's kind of value system. But that's what I mean by being specific to the firm. A lot of the people that have worked for me over the years are doing this in the companies they're at now. And yeah, it's harder now. It's a little bit more challenging. There's questions from lawyers, or maybe the board's asking questions, but they're all driving real business value today. Um,
Hmm.
and there's a lot of people that have lost their jobs or lost members of their team in this environment, and that makes it tough. And but I'm willing to bet there was something about that story they weren't able to convince other people what they were really trying to drive.
Yeah. One way that a lot of people in companies um, organize their thinking and find ideas is basically through like collective action groups and organizations. And so someone asked a question, we'll end shortly after this, but someone asked a question. They like David's views on the future of collective action within business sectors on climate, things like NZAM, I think that's Net Zero Asset Managers Alliance, NZIA, don't know that one, and Climate Action 100. Has their usefulness passed, and so should their and has their usefulness passed, and so their passage should not be mourned, or do we still need coordination within sectors? I guess what's the right way to think about relying on these organizations or just coordination among sectors looking
I,
forward?
I I have to admit that I'm a believer in the partnership model and the kind of shared learning, and even cross sector. Right, when I was in the food sector, it was not only the food manufacturers but the retailers that literally
Mm.
drove the sustainability agenda through something called the Consumer Goods Forum. Um, and when I did this back at Intel, we helped establish, what we called then the Electronics Industry Coalition, and it was like all the standards for all of our suppliers, and made not just change companies, but literally change the way sectors do sustainability or health and safety. So I'm a big believer in that. I do think the they've evolved or devolved, depending on who you are and what way you want to take. There's a very positive role they can play. It's a very thin line between helping, driving collective action, and advocating. And advocating today, and almost everyone you've mentioned has been named in some way or another as, antitrust against a certain sector, right? And that's dangerous today. And your general counsels, your lawyers, your boards of directors are looking at these things, and companies, trust me, many hundreds have gone through and looked at every single membership they have, and they've dropped some. They've hard looked at them. They've asked these groups to build in antitrust language that gets read in front of every meeting, because companies still believe there's value in the model, but they do not want to get sued. They do not want to be called in front of the House or Senate testimony about antitrust in a sector. I mean, it's every day in the paper. I don't have to name companies. I don't have to name sectors. So there's much more scrutiny over these things. And I think if I'm not there, I'm on the corporate side, I always have been. But if I'm running a group, and I've given these groups this advice, and I've helped ones that I've joined craft a framework that you can do this in a good way and stay out of those crosshairs. But it's hard to avoid wanting to do the advocacy, and some should. But today, in certain geographies, it's really tough to kind of combine those two.
Yeah. Um, Dave, this has been great. You've been doing this work for a long time. The fact that an organization um, as esteemed, but also very bluntly as rich and financially driven as Apollo continues to invest in doing that stuff. And like people love to talk about where's the business case? How do you make the business case? Like Apollo's doing it, and it's not because, like you said, because you can offer somebody 80 cents on the dollar. It's because you can offer them 120. And I think the fact that like you're leaning in and you're offering all this advice to people is both incredibly educational and helpful, but also very heartening. In our last minute here, um, any like final thoughts that are on your mind a lot? Anything I know you teach, anything that you continue to share over and over again right now?
I think we've covered a lot of it. I do think that there's a little bit of concern in the marketplace, and having conversations with people or having group conversations. There's definitely, I've seen where groups like this have been opened up. They're like, we're maxed out. Like everybody wants to be able to talk about this stuff, right? Like what's happening to them, because there's a lot of similarities. Like a lot of legal teams are acting the same way. A lot of boards are acting the same way. A lot of CEOs are asking the same questions of their sustainability people. The precision around language, companies are running around, they're trying to clean up things on their website. um, but I do think, from Apollo, like the Apollo perspective of excess return for unit of risk is something everybody on my team understands. Like it's simple, they get it. If what we're doing isn't helping the firm kind of raise more money, or better manage risk or deliver better returns, we're probably focused on something in the wrong spot, or we're not positioning it the right way.
Mhm.
A lot of education, and I do think that there are these core elements in every single company. It's frustrating for those, and there's many, and I was this way for many years. You go to a company and you think like, we should do this. This is the right thing to do. Um, and there's a lot of companies like, I hear you, but I'm not doing that right now. And that's really frustrating if that's what you went to school for. And that's, like the people that are bringing the sustainability mindset that we all have to change the company is their challenge today, right? The people that are at a company to build that company and use sustainability drivers, they're doing just fine. And I think that's the message that, I would kind of continue to try to coach people on. I know it's tough, but if you're helping that company using all your sustainability credibility and tools, like that's a win.
Yeah, beautiful. Dave, thank you so much. Thank you everybody for joining. Just to note, we do this every single Thursday. Next week, we're interviewing Brendan Maloney, who's the sustainability lead at DocuSign. The week after that is Christina Wyatt, the chief sustainability officer of Persephone. And then the week after that is Allison Taylor, an Eastern professor of ethics. So we got an amazing group coming up. Dave, thank you. I appreciate you. I'll see you soon.
Thanks, everybody. Bye now.
Bye.